All right, welcome back, everybody. John Caruso here, Senior Market Strategist with RJO Futures. This is another edition of Rolling Trades. Today, of course, is November 6th. I got a pretty action-packed day here for you guys. We're gonna briefly run through the Fed. Of course, we did hear from Fed Chairman Powell last week, where they did cut interest rates by 0.25%. We're going to hit on that a little bit. And then, of course, we're going to be a little more interactive here today. We're going to run through a few charts and predominantly focus on price action. I'm a macro guy. I always like to start with the macro. The cycle has generally been positive here as far as growth. We are starting to see some downgrades in global growth forecasts over the next 12 months. But into the end of the year and out into the beginning part of 2026, we still think things are generally in pretty good shape. So first, we're going to recap the Fed briefly for everybody. We did see Jay Powell and company cut rates 25 basis points to the target rate of 3.75 to 4%. Of course, Powell doubled down on his recent comments, suggesting that there is no risk-free path in terms of monetary policy. It seems as if they're going to try to double back and save the labor market, because we are starting to see signs of a slowdown in labor, and that is only exacerbated with the government shutdown here as of late. But if you reach back and save the labor market, you could unleash a hotter environment for inflation. So there is no risk-free path. He has mentioned that, and we certainly agree with that. That's something that we've mentioned in the past, that if it comes down to it, you start to see labor start to slow significantly here in recent, in upcoming months, that they will acquiesce to higher inflation, and they will save the labor market over inflation, even though they're going to continue to tell you that they maintain their 2% target on inflation. That's going on about 5 years. That's going on for about 4 years now. They've missed that 2% target. So shame on the Fed from that regards. And according to the projections, we may not hit that until 2027. So further taking a look at the Fed last week, of course, we did hear Jay Powell mention that there is no guarantee for a December interest rate cut. We did see the bond market and the CME Fed Watch actually quickly price out a December Fed cut, which we have seen that start to creep back in to the interest rate markets here since then. But he said December is not a guarantee, and then he doubled down and said far from it, which I thought was very interesting for him to actually double down on that. So personally, I do believe that they are going to cut in December. I think Jay Powell just needed to tell the market that he might not cut, just to kind of keep interest markets and inflation kind of on their heels a little bit here. So currently, there's 68% chance that they cut in December. A couple notable happenings that we've seen here in markets as of late. Of course, we are seeing stock market slide right now. We've got the S&P 500 about 3.5% off the all-time high. You got NASDAQ down about 4.5% from the all-time high. But we have seen the U.S. dollar just recently hit a 5-month high. I think that's very notable. U.S. dollar is something we've often harped on in the past. If you can get the general direction of the U.S. dollar correct over the near, intermediate, and longer term, we think that you're going to get a lot of things in the macro trading verse correct on a long enough timeline. BTC, Bitcoin, we saw that slice through our trend line of about 108. And we just recently broke 100,000 in Bitcoin. We have since stopped and reversed. We'll see if that can continue and carry us back above 108 trend. But right now, Bitcoin looks broken at the moment. And if we slide back under the 100,000 level, you could see a fairly significant drop from there. We're forecasting maybe 15 to perhaps 20% of downside in Bitcoin if we were to slice back under that 100,000 mark, and we can't recapture that significantly. Let's jump right into it here. We're going to move right into the charts. We're going to first take a look at the S&P 500. We've got that up here for you. Clearly a bullish trend that we're experiencing. If I actually wind this back a little bit here, let me see if I can take it back to April when this started. Of course, we saw the big correction in stocks in April. The bottomed out down along 5,000. Of course, that was on the announcements of tariffs, Donald Trump's Liberation Day. We did see that massive reversal candle, a little bit of a check down, and then we began to melt higher. I think a lot of people have been doubting this rally for the majority of the time it's been moving. But if you study the nature of this rally we've seen for the last 7-8 months, you get these massive melt-up phases followed by about 3-4 days of check down, followed by new highs, followed by about 3-4 days of check down, reversal bar, some range, a melt up to new highs. You get another 3-day check down, another melt up to new highs. This bar right here was a big shakeout, trying to keep the market honest. Then we saw, of course, the gap up. I believe that was on a Sunday evening, and then melt up into new highs. So now we are on about day 6, day 7 of this little bleed off here in stocks, taking us off about 3.5% in the all-time high. I have no reason to believe that we aren't going to find some support somewhere between about right here, 67.40, to possibly down into these old rejection bars down here, which would come in closer to about 66.50. Now, I do have this line, excuse me, because it's very generic. These aren't the charts that I actually use and study, but these are pretty much RJO stock charts that I'm using for this podcast alone. But this is obviously a very key level here that we have to defend if we do migrate back down into that 65.50 area. That is kind of a signal that if we do break that and we don't see a strong rejection intraday, that there could be trouble brewing potentially out into early 2026. So at the moment, I've got no reason to believe that this isn't going to find some support between about right here, 67.40 and about 66.50 for a stop and reverse back into all-time highs into the end of the year. I still think that we will see the S&P 500 stretch above 7,000 before the end of the year. The macro cycle still generally remains positive. Of course, you could have these swan events that come out of nowhere. Of course, we had a mild subprime auto loan, a mini crisis that we saw hit. That was back over here in October. But of course, we just saw that simply met with more buyers coming in as that did not prove to be something to really worry about over the very near term, or something that could be systemic. So that is the S&P 500, still largely bullish. We haven't initiated new long positions for clients yet or recommended that yet, but we are certainly warming up to that idea. Now we're going to flip over and take a look at, what do we got next here we're going to take a look at gold. Gold's been a trade that we've been hot on for more than 2 years, still carrying core long positions. We've had a position on for a significant period of time in various sizes. Now, you don't want to be fully invested in the gold market at all times, but as you can see right here, this melt up phase that we saw, that was certainly a good indication that you wanted to be aggressive buyers in gold. I'm going to move this back to what we saw from about April until September. We saw about 5 months worth of range-bound trading, just range-bound trading. And when you get range-bound trading for 5 months and you break in one direction or the other, that's typically going to signal a massive breakout, a massive move. And of course, we did see about an $800-900 move in gold once we broke through that 3,500 level, which of course we have been riding the entire way. Now, fast forwarding to bringing it back to present day, what I see here is just more range, more consolidation over about a 7-8 day period. And we're just really trying to search for direction in gold. I do think ultimately this chart, if you expand it on a weekly and a monthly chart, I think what gold is going to do is it's just going to build out a bull flag. Now, whether or not we've seen the low in this mini cycle that we're in still remains to be seen. If we were to break back under 3,900 and hold, that's going to be a pretty ominous sign that I think we could see another 2, potentially 300 points in downside in gold. But that would still remain bullish trend in our technical model. It really would have to break down significantly through 3,500 for it to really change. But you have to pay attention to the different time frames that we offer to our clients on a daily basis. We have the intermediate, the near term, intermediate term, and longer term trend. And gold measured on a 3 to 6 month basis still remains bullish trend. Momentum has neutralized. We certainly don't want to see that break down. But all in all, I'm just seeing range bound trading, and I'm gonna use 40-60 on the upside. That would offer a friendly long side in trading environment if we were to get back above there, and of course 3,900 on the downside. You want to respect those levels right there, and we might continue to just build out this range until we do hear from CPI next week. Of course, we're going to get the November CPI release. We do have some suspicions and some modest forecasts that we will see a cool down in CPI versus the expectations. We have seen the owner's equivalent rent over the last 2 months start to show a pretty drastic rate of change slowdown. And of course, housing accounts for a major piece of CPI and how CPI is calculated with headline inflation. So if that were to be the case, I think that's going to put the Fed back on the table in December if we were to see a slowdown in CPI. You couple that with some more indications that we're getting a slowing labor market, and the Fed comes back into view, and I think the dollar could potentially fall back on its heels during that period, which could expand the price action in gold. So if we get back above 40.60, I'm going to give it a chance. 40.60. And then 41, we're going to say 41.70. If we were to clear those two levels, so 40.60, then 41.70, we could potentially stretch all the way back across the range and retest the all-time highs up there over just over 4,400 in gold. So that's how I am viewing gold at the moment. I am still holding or recommending that we hold core long positions in gold. That chart is certainly innocent until proven guilty of higher price action. Flipping over, taking a look at silver. Silver, very similar action to gold. This is just simply range. Let me throw that box in there for you. See if we can get just really outline that range trade. There it is right there. We're just seeing chop range trade. Between about, we'll call it 49 on the upside and about 45. We saw that low come in down along about 45.90, we'll call it. So I think we're just largely going to stay trapped inside of that range until we hear from CPI next week. If CPI confirms that the Fed could come back into view with a rate cut in December, I think ultimately silver is going to break higher into the end of the year. If we do get a hotter CPI reading in November, and we start to get the sense that the Fed may not cut in December, I don't think silver is going to like that very much, and perhaps we could break back through the low end of that range of about 45.90. If we were to see that, you've got to be conscious of the 20% correction mark in silver, which would bring you all the way back to about 43 in silver. I have been paying attention to those correction levels. Obviously, 5, 10, 15, 20%, those are benchmark levels you want to pay attention to. If we were to see a 20% correction in silver, I certainly think I would be a buyer down along those levels. We still think the longer-term plans by the United States Treasury and the Federal Reserve are for a dollar devaluation system. We do think that the dollar on a long enough timeline is likely going to migrate lower, even though we're seeing this intermediate period of strength in the USD. And of course, you couple that with some of the supply and demand side fundamental supply. For silver, we have seen we've seen a supply side deficit for the last 5 years now. So it's going to take a lot to kind of burn that off. The gold to silver ratio certainly lopsided at about 85-1. So still very bullish on gold and silver. Really have no reason to change our long-term outlook for those markets. But of course, we're going to pay attention to price action. Price action is king. Price always moves before the fundamentals catch up to it. So that's one of the reasons why we're highlighting the price action here today for everyone. We are going to jump over and switch. Let's see here. What do we got next here for you? I'll take a look at copper. Let's take a look at copper here. This is a market that we've held core long positions in and still have some small core longs in. We did see, of course, the big wipeout in copper off of the tariff announcement that Donald Trump was not going to be tariffing copper ore. When we saw that, you did see the big sell-off. Pretty nonsensical, if you ask me. The supply side problems in copper are going to persist for the next at least 5 to 10 years, we think. You've got a lot of problems in copper. Production is beginning to stagnate out of South America. Of course, we did hear from the Freeport-McMoRan Grasberg mine that went down a few weeks back. That's more production coming off the line. We've got projections for a year-end supply-side deficit in copper of roughly 300 to potentially as much as 500,000 pounds in copper. You look at the electrification story. It's a great story. It's a true story. You've got a lot of electrification happening. These AI data centers, you see all the CapEx spending that's going in that these mega cap tech companies are doing with AI and infrastructure build-outs. You look at the power grid just here in the United States and the workload that's going to be the demand workload that AI is going to put on the U.S. power grid. We need infrastructure upgrades. We need to expand the grid. So copper plays certainly an instrumental role in that. We are starting to see copper start to chop around a little bit. It kind of looks like the S&P 500. You had that massive sell-off, and then we saw the rally into new highs. Now we're starting to see another bleed off here. I still think copper looks pretty good on a daily chart. I think if we were to chop in here for a few days, I still think that we're going to ultimately turn back up into the end of the year. The economic cycle still remains favorable here in the United States for further copper price expansion. So we're going to stay bullish on copper until our signal changes. That's been a core long position. We've carried a long position there in various sizes. So we will gross it up on big down days like we saw experienced here, degross it on the rallies, gross it up, degross it, and look at grossing it up again. We actually did fire out a trade signal recently to our traders. I believe that was at $4.94, the recent drop under $5. We thought that offered a pretty good short-term value point, and we issued that to our traders. So we're going to jump over, change markets here. Let's take a look at, I got platinum here. Let's take a look at platinum. Same thing as gold and silver, largely seeing a lot of range. If I go back in platinum, I mean, there was a period of time in platinum. I'm not going to take a look at it on the daily, but there's a period in platinum for about 5-6 years. Platinum prices did absolutely nothing. They stayed in a massive sideways range, and then we saw a huge breakout in platinum. I have no interest in taking a look at platinum from a bearish standpoint currently. I will continue to look at trading that on the long side. This is potentially a generational breakout we're seeing in platinum. The all-time highs, we've still yet to achieve those. All-time highs in platinum are up around 2,300 an ounce. But similar to gold and silver, we're just seeing some back and fill, some consolidation right here within this range. I think that's likely going to continue. I think ultimately we will stave off lower prices and ultimately begin to move back up and challenge the year-to-date highs, which come in just under $1,800 an ounce in platinum. So you can pick up on the theme here. I am still generally very positive on the metals markets. I don't see any reason to really cut and run from that outlook at the moment. So let's take a look at what else do we have here for you. Natural gas. This is interesting, and this is one of those markets that I think it really drives home the point I'm trying to make here as far as price action is concerned. The fundamentals for natural gas are still overwhelmingly bearish. You've got the injection rates on a 5-year look back that are above the 5-year norms. You've got supply that is sitting above the 5-year norms as well. We've got from a seasonal standpoint, warmer weather is forecasted for natural gas here in the early part of the winter. And we are seeing a price breakout in natural gas. Natural gas, of course, is another one that plays into the electrification and the AI demand story. So this could be the beginning stages that we're seeing there. Of course, we saw the false breakdown here in natural gas, then the sharp reversal back to the upside. We did see a lower high and then a higher low made. Big move right here. This candle right here was a signal that you should be looking at trading this with a bullish side bias. And now, of course, we did break above those highs that we saw in October. And I do think natural gas, perhaps followed by a little bit of a check down here back into 4, I do believe we're going to see another higher low made, which is going to carry us into higher price action, potentially as high as $5 between now and the end of the year and out into the beginning part of 2026. So natural gas, that's one that we've got on our radar. We actually do have some small long positions out there. We've advised clients with that. But we are getting a little bit top heavy here over the near term in natural gas. So if we were to see a check down into 4, we'd be looking at grossing up core long positions in natural gas. Lastly, let's take a look at crude oil. Crude oil is in big trouble right now, if you ask me. This is a clear bearish trend that we're seeing in crude oil. Crude oil recently just went through a little bit of a consolidation period. Let me go ahead and get rid of this alert box here. Once again, this isn't my typical trading view on a daily basis, but we're using these for the podcast purposes because they are very interactive here with this. Okay, taking a look at crude oil, we see that rally, that 3-4 day rally. A lot of that came on the OPEC announcement. They are going to be modestly cutting production, but going to be freezing production out into early 2026. So that's the reason that we saw that big rally. Then we saw a little bit of a range. We saw a failure to make a new higher high above that swing target. I can't even if we were to stop and reverse here, I can't get us much beyond this 64 area before I would think that we'd see another move back down into probe the mid to low 50s again. But right now, it kind of looks like we're trying to break down in crude oil. We are back under 60, trading probe in the low 59 handle right now. And this could be getting ready to make its final descent in crude that could take us back to as deep as 54 or 53. So as far as price action is concerned, we remain bearish trend. Momentum is still neutral in my technical model, but that is soon to be breaking down. If we lose 59, that's going to be breaking to negative. I do actually have it immediate term oversold at these levels, but if we do lose the neutral momentum indicator, it's not going to take much for that thing to sweat off the oversold signal and then resume its descent potentially into 54. So crude oil still looks very ill out there. I do think on a longer term basis, the energy markets are something that you're going to want to look at, but we're really not ready to go in that direction quite yet. So we are going to flip back here. And we're going to say thank you for joining us once again. If this was helpful, please be sure to like and share. I do go through a lot of these insights on a daily basis in my Market Insight Note. It is free of charge. If you want to jump on our real-time trade signals email list, feel free to ping me, jcaruso@rjofutures.com. You want to jump on the Market Insight Note, would be more than happy to share that with everybody. And that's all we have for you here today. So best of luck to everybody out there. We'll catch you back here next time.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.